For most of 2013, we've begun this program with talk of record highs and winning streaks for stocks. Tonight, it's a losing streak, the first three-day stretch of losses for the Dow so far this year. And the losses have not been small. Today's nearly 127-point Dow decline followed yesterday's 117-point drop and was the fourth triple-digit loss for the Dow in 2 weeks. Investors are increasingly worried that a big multi-year change is taking hold. It's not just concern that the Federal Reserve may pull back on its bond buying program, sending interest rates higher, though they have risen sharply since early May, including today. It's that China's economy may be slowing, pulling down emerging market countries with it. Emerging market stocks off 10% since their peak in May. Brazil's market down 20%. Japan and Europe aren't out of the woods by any means yet, and the big asset manager PIMCO says there's a 60% chance of a global recession in 3 to 5 years. Adding to Wall Street's worries, the dollar index, which tracks the strength of the U.S. dollar against a basket of currencies, touched its lowest level in 4 months today. At the end of another exhausting day, the Dow finished down more than 126 points, ending below the 15,000 threshold. The Nasdaq, 36 points lower, and the S&P 500 off by 13.
So what do all these global developments mean for your investments and your business? Joining us now to talk about all this, David Kelly. He's Chief Global Strategist at JPMorgan Funds, and Ira Jersey, Director of U.S. Interest Rate Strategy at Credit Suisse. Gentlemen, welcome. Ira, let me begin with you and just ask you that, do you agree that we are entering some kind of new era, and how much risk is the global economy really facing?
I don't think you could say we're in a new era quite yet. I do think that the market's getting a little bit ahead and a little bit shaky, thinking about what policy changes might be in store. You saw a lot of volatility yesterday after the Bank of Japan did not give you more information about what their end goal was for their current policy of their own bond buying program. And the market has really been on edge the last month or so concerning whether or not the Federal Reserve will continue to its own bond purchase program. In fact, the way that we view it, the market is actually pricing in for a very bad policy mistake by central banks, not only in the U.S., but indeed globally.
David, is the market overdoing it, as Ira suggests there? In other words, are they pricing in the possibility not just of a tapering, but maybe of a complete canceling of the bond purchases? And why are the emerging markets taking it so hard?
Well, I think two things. First of all, I think there are some genuine economic problems in emerging markets. China is growing more slowly, and you can see an inflation problem in India. You've got a bit of an inflation problem in Brazil too. So there's some growing pains there. But in the long run, I think emerging markets will grow more quickly than the developed world anyway, and I'd want to have some assets there. Well, overall, I think markets have been going up very strongly, particularly in the United States in recent months. They're due for a pullback. You can never time exactly when that's going to happen, but I think that's what's going on. But fundamentally, I don't believe that rising interest rates threaten the U.S. economy. I think the U.S. economic expansion, it's like a tortoise, it's not a hare, but it's a very steady tortoise, and I think it will continue to grow through rising interest rates. And because of that, I think long-term investors should still be overweight equities, underweight fixed income as interest rates rise.
Well, let me ask you more about that, David, in terms of what should investors be doing to prepare themselves for higher interest rates. For the longest time, all year long, even last year, money managers everywhere were saying time to get out of bonds and put more money into equities, and we haven't seen that so-called great rotation happening. Is now the time? I mean, what are you doing with client portfolios?
Well, I think the important thing is not to try and time it too precisely. We don't know, but what we do know is that interest rates are too low for a recovering economy. Gradually, the unemployment rate is coming down in the United States, and as the Federal Reserve continues this policy of QE, it's getting to be a bigger and bigger balance sheet, which is going to be more of a problem when they try and reverse things. Because of that, they are going to eventually taper QE and eventually bring it down to zero accumulation, and that is a big change, and that will push interest rates higher. So the key thing is, don't try and time this, but position your portfolios correctly today for higher interest rates. And that means not only being a little overweight equities, a little underweight fixed income, but also within equities, a little overweight those less interest-sensitive sectors like technology, and be a little light on things like utilities. Within the fixed income market, overweight things like high yield, convertibles, floating rate, underweight things like treasuries and tips, and high-quality corporate bonds, which tend to get hurt when interest rates rise.
So, David, Ira, David has given us a wonderful smorgasbord of possibilities there. He says overweight equities, but what if you're not? What if you're overweight bonds? Bond yields yields have been rising dramatically. When people get their end of quarter statements, I suspect that some of them are going to be quite surprised. What should I do if I am overweight bonds and mortgage-backed securities right now?
Well, we agree with David's premise. In fact, in our model portfolio, we're underweight treasuries, and we're underweight the long end of the treasury market in particular. So we have shortened duration. We're more buying 2-year, 3-year, 5-year bonds instead of 10-year and 30-year bonds. And we do like corporates. I think, there are things like investment-grade corporates. You can get some quality names with some spread, and by buying those instead of treasuries, for example, you can pick up some incremental yield. I do think that the market that you've seen over the last couple of weeks, though, does present a big problem, and I think this is an important point. And that's that Wall Street cannot warehouse as much risk as it used to be able to. So things like bid-offer spreads on a lot of bond market products, so things like corporate bonds, like high-yield bonds, and like mortgage bonds, have widened quite substantially because Wall Street balance sheets are much smaller. So the amount of bonds that they can buy in these sell-offs is more limited, and because of that, you're going to wind up seeing much more volatility as risk gets taken off of portfolios by money managers.
Ira, I'm sorry to cut you off. We're just going to have to leave it there. This is a complicated issue. You did bring some clarity to it for our viewers tonight. Thank you, gentlemen, both so much. David Kelly of JPMorgan Funds and Ira Jersey of Credit Suisse.